I'm excited to have you here. We're going to be talking about real estate investing and more specifically, how to create a portfolio of profitable rentals that produce what we call mailbox money. And that I define as consistent rising income with tax benefits that come from a tangible asset that, we all understand and that increases in value over time. Mailbox money, right? So we live in a cash flow world. Back when you last rented, do you think your landlord had a smile on his face when he cashed his rent check? Right? I mean, there's a good chance, right? Our bills are typically due monthly. And so shouldn't our investments pay us the same way? Ask yourself this: how would your life be different if my investments were setting me a consistent paycheck? Wouldn't that give you peace of mind? A big part of the retirement problem in America is that we lock up our money for decades in confusing products that most of us don't understand and that often benefit Wall Street more than Main Street. Would you agree that most Americans have no idea what their retirement income is going to be? As a result, most Americans don't save enough. They don't grow their investments fast enough, all because they don't understand retirement well enough. So I want to change retirement for the people in my life, for the people that my business comes in contact with. Dan and I both do. We've all been on the wrong side of mailbox money. We call those bills, at one time in our lives. And my goal is to change that, to help you diversify out of Wall Street, to understand your investments, to create an alternate stream of income, and to create a legacy. And this isn't dumping on financial advisors. I believe that real estate investors should have financial advisors because what I've seen is they help them make better real estate decisions. All right. So here's an example. This house is on Essex Avenue in Warren, Michigan. The investment fund that I run paid $73,000 in cash for it in May of 2023. It rents for $1,125. Later, we put a mortgage on it, leaving 25% equity into it. And we took out a 30-year fixed rate mortgage at 7.125%. That makes my mortgage payment, including taxes and insurance, just $522 per month. Now, here's the kicker. That's not even the best cash flow we've achieved in that particular market. There are other homes we've purchased that produce even higher cash flow. Now, if you follow Robert Kiyosaki, the Rich Dad, Poor Dad author, then you might know Tom Wheelwright, who's in the center of this picture here. He's Robert's CPA, and he's also the author of the book Tax-Free Wealth. And I'll tell you, of all the books on tax strategies that I've read over the years, the Tom Wheelwright's book is the clearest and most easily understood. He's an outstanding author. He's a very good writer. He was paid to speak at this massive real estate event called Built How. And my business coach is one of the founders of the event. As a result, my wife and I, who's in the picture there with me, had a chance to meet Tom.
And this is Remy Adelike. Remy's a retired SEAL. You may have seen him on Special Forces TV show. He lives down in my neck of the woods. And he wrote a book called Transformed. And what really blew me away about his life and the transformation of his life is what Todd talked about, is helping people transform, turbocharge, as Todd likes to say, turbocharge their retirement. And that's what we want to do. And I just thought about including that because the name of the book is Transformed. I highly recommend it. It's amazing.
So in the time that Dan and I've worked together, we've helped investors acquire 195 rental properties, almost all single family houses. I personally purchased my first rental property 24 years ago. It's actually pictured there. It was a triplex. Along the way, I've had some wins, some losses, and I've learned a few lessons. And I've heard it said that there's two types of experience, earned and borrowed, and that the borrowed experience is far cheaper. So our goal today in our small amount of time together, and we're going to keep this under an hour with the questions and everything else. The presentation takes probably 35, 40 minutes. Our goal is to share with you the most important lessons from, our experience and our studies. So let's make a deal. I'm going to give you as much content in our short time together. It's not a commercial, but what I ask is, turn off any distractions, grab a pen and paper so that if you have questions along the way, and again, for those of you that have read the book, you may have more specific questions than you had before reading the book. So write those down. We'll get to those at the end. And I just want to ask that you commit to finding one or two good sort of actionable items or ideas so that our time together was well spent. Is that fair? So at the end of the meeting, I'm going to do, with your permission, I'm going to take a few minutes and just share an opportunity that you may find incredibly valuable or not. It's up to you. I'm not going to do a commercial. This is just content from 24 years of investing experience. At the end, I'm going to answer questions. So let's march on. In the meantime, though, there are going to be a few things that we have to deal with if you're going to be successful with real estate investing. Legitimate concerns. The first is time. Some of you may be already thinking that you can't afford to learn this by trial and error, and you just don't have the time to study this. To me, this is the biggest challenge of all. I understand that you find yourself most likely in a situation today where time's a premium. We're all busy, right? So the fact is, the less time you have, the more you'll love the approach that I share with you today. You may also have some confusion about real estate, which is totally normal. Where do I start? How will it all work? Finding a property, screening a tenant, dealing with maintenance, etc. I get it. If it were clear to you already, you'd already be doing it. But what one man can learn, so can another, and you aren't going to be on this journey alone. Another concern you may be thinking is, what if I screw this up? Right? Well, newsflash, probably will, but we're going to put a system in place that limits the downside while maintaining the upside. We're going to limit the danger. Today, you'll discover some tools and tricks to mitigate the big dangers so that any mistakes are small change. In other words, you'll learn your way to the bank. Given all the weird stuff that's going on in the economy in the last couple of years, you may also be thinking, is this the right time? Did I miss the boat with the big run up in prices in 2020 and 2021? Should I wait for a better time? Interest rates are high. I get it. Because before I put all the pieces of this puzzle together, I wondered that as well. Today, you'll discover the way to know exactly when to invest and under what criteria to ensure that you've made a profitable investment. So let's say I had a time machine and I let you take it for a spin. You hopped in and it brought you the exact point where you've mastered everything I'm about to show you today. You have the ability to help the people you care about because you're in a much better financial position. You're more confident in your ability to create and grow wealth than ever before. What are you going to do now that you have all this extra time in your hands? Because you've replaced your income with mailbox money, steady passive income from your rentals that you receive that in your mailbox. You can play more golf. That's true. But what are the higher pursuits that you've always wanted to go after, yet in the past seem like wishful thinking? I bet they're good things. In fact, I bet they're great things. Things like more time with loved ones, time to volunteer at your church or charity that matters to you. So I like this quote from Jim Rohn. He expressed it well when he said, set a goal not simply for the attainment of the goal, but for what it makes of you to achieve it. In this webinar, we're going to discuss the means, but the end is who it makes you as a person. And that's exciting to me because if we want to have a more generous world, I've got to help people have more money. And that's really what this way of investing is about steady passive income. So we're going to talk about why real estate is an unfair advantage when compared to other investments. The one other element of real estate investing that matters more than any other. The right strategies to mitigate the danger in your investment. And of course, we're going to do some case studies. So let's start with the fact that real estate has an unfair advantage. There are 4 benefits that real estate investing has that other investments only have some of. The 4 benefits are appreciation, cash flow, tax advantages, and leverage. Now, let's look at the first one, appreciation. Growth stocks are purchased on speculation that they'll rise in price over time, enabling the investor to sell at a higher price for a profit. Real estate provides this same benefit and has averaged over 4% annual appreciation since 1940 when the Census Bureau began tracking it. In fact, it's nearly 5% nationally. So here's how to put a 4% rate of appreciation into perspective. Your property value will double every 18 years. That's a $73,000 rental house will be worth $146 in 18 years, like the first example I gave. Okay. Second benefit is cash flow. Both bonds and rental properties produce cash flow to the investor. With regard to rental property cash flow, I'm referring to the money left over after the rents, like all expenses and set-asides have been taken out, including amortization on a loan. Now, going back to bonds, with very few exceptions, the bond income is fixed and doesn't change during the life of the bond. It's just a set fixed payment. However, rental income does increase over time, and since it tracks real estate values usually there's a little bit of a lag, it has also increased at over 4% annually since 1940. Again, Census Bureau data. Thus, your $11.25 per month in rent in the example I gave earlier will be $22.50 per month in 18 years. Meanwhile, your mortgage payment has remained the same. Bonds don't do that. So isn't it starting to get unfair already? Now, leverage, this is where it really gets unfair. Real estate has tax advantages that stocks and bonds only wish they had. Some bonds produce tax-free income, and stocks can be owned in a Roth IRA, thus making their growth tax-free. But only real estate has the option to produce tax deductions that have the ability to not only make your cash flow tax-free, but can also be used as a tax deduction against other income with some caveats. But an ability that's there for the right investors. So you think about having more take-home pay from your job because your real estate investment assisted you with that. That's pretty cool, right? And then I jumped ahead of myself there a second ago with leverage. So the last is leverage, and this is where it's just no holds barred, completely unfair, because no other investment can employ the sheer amount of leverage that real estate can. Leverage is borrowed money used to purchase the investment. Stocks and bonds are only allowed to be leveraged up to 50%, but real estate can be leveraged up to 100% of its value.
I had 3 people stop.
There we go. More than that, the financing that you can employ is fixed and stable with a long-term payment structure, such as a 30-year fixed rate mortgage. Once you have it in place, your loan's no longer subject to market forces. If the cost of the money you borrowed is less than the investment produces, then the leverage magnifies your return. So I'll say that again. If the interest rate on your loan is lower than the return your investment produces, then your loan increases your rate of return. So let's look at a math example. What I'm showing there is a $400,000 property purchased for $400,000 in cash. And we're assuming that after all expenses to operate it, that the net income, what we call that mailbox money, the spendable cash flow, is $28,000 a year. That would be a 7% rate of return on the $400,000. Now, if we assume a 6% loan and instead we buy 4 of these properties, each one, that middle line is showing one with a $100,000 down payment and a $300,000 loan, because the interest rate is lower than the rate of return at 6%, that same investment would produce $10,000 in net income. And so if we multiply that by 4, we'd have $40,000 in net income. And so in that case, the leverage, the financing enables the acquisition of 4 properties instead of 1, and enables a higher cash flow, a higher net income. Leverage magnifies returns. So real estate has an unfair advantage because it can appreciate, because it produces cash flow that can also rise over time. It has an unfair advantage because it offers tax advantages. And finally, real estate has an unfair advantage because it can be leveraged at a higher rate than any other investment, and leverage magnifies returns. Now, we're going to talk about the one element of real estate investing that matters more than any other, and that's cash flow. Between cash flow, appreciation, and the tax benefits that come with real estate investing, cash is king. So appreciation is like a pig. You don't get a meal until you slaughter it. While appreciation creates equity, you can't spend it. You have to first convert the equity into cash. In order to bring home the bacon, you have to sell the property or do a cash out refinance. But that's a little like ending up with a 3-legged pig. You kill your cash flow in order to have the ham. An investment property that produces cash flow is like a hen that consistently lays eggs. It's dependable. As we talk about why cash flow is king, we're going to discuss the problems with investing primarily for appreciation, which are a problem of compounding, of lower cash flow, of volatility, and then the 4 threats to equity. So the first problem of investing for appreciation is the problem of compounding. Albert Einstein famously said that compound interest is the most powerful force in the universe. You can't reinvest your appreciation unless you slaughter the pig. Thus, you cannot compound equity. However, you can compound cash flow. Wall Street understands this, but Main Street typically doesn't. You can reinvest your cash flow into other investments. Your eggs can produce more hens. Your cash flow can become the down payment for your next property. Isn't that an exciting thought? So significantly lower cash flow is the next problem with investing for appreciation. The markets that produce higher appreciation also produce less rent as a percentage of the price. So for example, $1 million home here in San Diego, owned free and clear, would be around $4,000 a month in rent. For that same amount of equity, other markets would produce $10,000 a month. You may recall the character from the Popeye cartoons that I have there on the slide. His famous line was, "I'll gladly pay you Tuesday for a hamburger today." In essence, an investor provides the hamburger up front and has to hope to get paid back at some Tuesday in the future. Not only do they have the opportunity cost of half the rent, they're also speculating that one of the four threats to cash flow won't affect them. In a bit, I'll cover what the four threats to cash flow are and how to mitigate them, but think about this. The appreciation market starts out $6,000 per month behind the cash flow market. You're going to need to have a significantly higher rate of appreciation to make up that ground. Never mind the fact that cash in hand beats profits on paper. All things being equal, I mean, wouldn't you want more rent rather than less? Just makes sense, right? The third problem investing for appreciation is volatility. Those markets rise the fastest in good times and are the first to fall in bad times. They can depreciate, and a bear market can wipe out your profits. That's kind of like spending money to fatten up the pig, hoping to sell it for a large profit, only to have a bear break into the pen and eat the pig. Rents don't have this problem. Rents are sticky. They lag behind the rise in housing prices, and they rarely decline. Barring something like Hurricane Katrina blowing through New Orleans and causing the city to empty out, the worst case with rents typically is that they just flatten out for a period of time. Your hens are safe in the hen house, right? Now let's compare appreciation markets against cash flow markets to see how they each handle the four threats to equity. The first is a lawsuit, which requires cash to fight and cash to pay a judgment. Second is foreclosure, which results from an inability to make the payment. Third is depreciation, which we've already talked about. And the last is appreciation, an increase in property value. That may surprise you, but it's the catalyst for other things, such as an increase in property taxes or the need to raise replacement cost coverage on an insurance policy. Sometimes it can even be the catalyst for a lawsuit. Someone with a large amount of equity can become a target. All four of those threats, lawsuits, foreclosure, depreciation, and appreciation, can be mitigated via cash flow, but not with equity. For example, a property that cash flows in a depreciating market is throwing off profits despite the decline in values. The four threats to equity are like being caught in a rainstorm, like these two ladies here. If you have cash flow, you can buy an umbrella, but you can't with appreciation. So hopefully you're starting to see that investing primarily for cash flow makes more sense than investing primarily for appreciation. So here's what we've covered. Investing for appreciation is like raising a pig, because you can't spend appreciation, you can't compound it. To do either, you have to slaughter the pig, to convert the equity to cash. Also, you receive far less in rent, which is like giving away a hamburger today, hoping to get paid on Tuesday. Appreciation markets are far more volatile. The bear could kill the pig. And finally, when the threats to equity rainstorm catches you outside, you're going to buy an umbrella with cash flow, but not with appreciation. And that's why cash flow is king. It's the goose that lays the golden eggs. It'd be nice if more money showed up in your life more often, right? Investing for cash flow instead of appreciation does that. It produces mailbox money. At this point, we've talked about the fact that real estate has an unfair advantage and that cash flow is king. Now let's move to the right strategy to mitigate danger in your investment, which is buy right and the market doesn't matter. The better you are at picking the right investment, the worse you can be at everything else. In other words, if your ship is sound, the rising and falling of the tides won't affect it. With real estate investing, there are four criteria to mitigating market danger. Buy the right community, buy the right inspections, buy the right financing, and buy the right management. If you do those four things, you'll buy right and the market won't matter. So let's start with buying the right community. We want to build a house on rock, not on sand. The community is the foundation for the investment. Research the metropolitan area and the communities within that metro area, because every metro area has sweet spots for investing. Stable areas where high quality tenants want to live, but that isn't so expensive that they're priced out. An area that's gentrifying is a positive sign. Imagine you've just toured a small 3-bedroom, 1-bath home with your real estate agent, like I did in 2022. It's an older home in an older neighborhood, but it's been tastefully remodeled. Gone's the old 1960s bathroom. It's been replaced with a fully tiled shower, new vanity, new tile flooring. In short, bathroom looks great. The kitchen's had the same treatment done to it. The house looked good. In fact, The whole house has been freshened up and appears to be in really good shape. As you walk out of the house to head back to your car, you notice the neighborhood's all single family homes, except for a couple homes just 3 doors down. Those 2 homes look like they were recently built, and they're 2 stories. So you ask your realtor. She proceeds to tell you that those 2 lots previously contained homes like the one you just looked at, but a developer recently came in, tore them down, and put up 2 houses, which are each 5 bedrooms, 3 baths. Unless that developer's a complete fool, you just found a fantastic indicator that this is the right kind of community. The area is gentrifying and will perform well as a buy and hold investment. Thus, buying the right community is building your house, your investment portfolio, on a foundation of rock. Just makes sense, doesn't it? So the second criteria is to buy right and ensure that the market doesn't matter. If you buy the right inspections, right? We want to go into this with our eyes wide open, not with a blindfold. The best way to accomplish this is to pay experts to look into, every nook and cranny of the prospective investment, and then provide you with a detailed report with pictures and notes so that you have a full understanding of the condition of the home. This is more than just a standard home inspection, although a home inspection is often the jumping off point. Anything that comes up in the inspection, we can bring in subject matter experts to give us their detailed reports and cost estimates for repair or replacement, because you'll see it better with their eyes than you'd ever see it with your own. Maybe the home inspection highlights the age of the water heater and the HVAC, for example. So you call plumbing, heating, and air company, and you get their professional opinion on the condition of the system. Maybe in this case, they recommend replacing the water heater, and they give you a cost estimate for doing it. So quick check of vendors in the area tells you their bid's reasonable, and it's within the budget you set for getting the home rent ready. So you make plans to do that after you close. Also, they tell you the HVAC is in good working order and should continue to be reliable for several more years. So, you check it off your list. Nobody likes surprises, right? So buying the right inspections prevents those surprises, doesn't it? It takes the blindfold off. We go into the investment with our eyes wide open. The third of the 4 criteria for buying right is buy the right financing. There's a saying that when the person next to you loses money, it's a recession, but when you lose money, it's a depression. Now, losing money on an investment, it would be fair to call that a financial crisis, wouldn't it? Buying the right financing avoids your personal financial crisis. A decade ago, people who thought you were investing were, in fact, in my opinion, gambling. They bought properties that wouldn't cash flow if they had a fixed rate mortgage. So they took out variable rate mortgages, often with prepayment penalties and teaser rates, and sometimes even a balloon payment. This is a requirement to pay off the mortgage early in a lump sum. So they foolishly bet that either rents would increase fast enough to make up for the future interest rate increase, and that the home value would climb enough to make up for the losses. In essence, they were betting that a bigger fool would come along to buy the home from them. Buy the right financing means take a long-term 30-year fixed rate mortgage that has a stable payment that will never change, has no balloon, requires you to have additional savings as a safety net. The lenders, the underwriters, they don't want you, all in. That's gambling. So you buy a home with the right financing and it cash flows up front. And then the magic happens. This is the coolest part. Rents increase over time, but your mortgage payment stays exactly the same, at least the principal and interest portion. A couple of years down the line, you're cashing bigger and bigger checks, right? Buy the right financing and you'll avoid a financial crisis, okay? The 4th and last criteria is buy the right management. A good property manager is like a bouncer at a nightclub. They're only going to let the right people in. The most obvious right people are tenants, but it extends beyond that to service people and their own employees. When repairs need to be made, we want them sending in the right technicians, individuals who will act with honesty and integrity, who are skilled at their trade, and will do the job correctly. When their employees show the property or do the turnover with an outgoing tenant, we want them to be thorough, honest, and ethical. Be fair with the tenant, but protect our interests. So it's like this. You get your monthly check and notice that your usual $5,200, in the check is a little bit lower that month. It's maybe just a little over $5,000. So you peruse the monthly statement and you see a note that they replaced the compressor on the HVAC. You remember that when you bought the home, you paid for an HVAC inspection, and that guy had said that it would need to be replaced in the next couple of years. So it's not a surprise. But then the next thought occurs to you. I didn't even pay for that. My tenant did. And I still have a positive cash flow. In short, a good property manager, like a good bouncer, is going to protect your investment. It makes sense, right? So to review, you buy right if you build your house on rock, not on sand, by doing your due diligence on the right community. You buy right if you go into the investment with your eyes wide open. You take the blindfold off by doing all the right inspections. You buy right by getting the right financing, which avoids gambling, avoids a potential financial crisis. You buy right if your property manager, like a good bouncer, only lets in the right people. Therefore, if your ship is sound, the rising and falling of the tides, they don't matter. And when I was writing this, I thought about using an analogy that like you can weather a storm, but that isn't the right analogy, because if you buy right, then there is no storm. You'll just have the rising and falling of the tides. If we follow 4 steps to buy right, then we don't have to fear screwing this up, do we? These 4 steps ensure mailbox money. Okay, so at this point, we've talked about the fact that real estate has an unfair advantage, the cash flow is king, and that if we buy right, the market doesn't matter. So I'm about to jump into some case studies. Dan, is there any comments or anything you want to jump in on?
No, I think you're good. I think one of the things that we've often discounted in the past, I'm going back years, Todd and I, is the importance of cash flow. And through our recent experiences and the case studies will highlight how the paradigm has really shifted. It's been an eye opener to say the least.
All right, well, let's jump into the case studies. So the first one was a home that my team and I recently helped an investor sell in Bonita. The client was introduced by his financial advisor, Edward Jones, and he had this vacant property in Bonita that he'd been self-managing. And he was undecided on what to do with it, keep it as a rental or sell it. He had some reasonable nostalgia about the home because his father had built it in the early 1980s and he was raised there. In the early 2000s, he bought the home from his father. As a rental, the last tenant had paid $4,000 per month in rent, and a recent prospective tenant had offered $5,000 per month, which we figure would have yielded about $1,900 a month in spendable cash flow. Again, what I like to call mailbox money. So one of the concerns with renting it again was the deferred maintenance on the property. The estimated market value was around $1.4 million, which meant he had significant appreciation in the property, roughly $1 million. The question was, what should he do with it? All right, so in analyzing his goal, his first goal was to maximize the income potential of the wealth that was in the property, with the hope that in 5 to 10 years, he could position himself to buy his dream home. And as we discussed some of just the basic principles of his investment in relation to his goal, we centered on, the rent to price ratio, which is rent as a percentage of current market value. So $5,000 in his case divided by what we thought the market value was, rent to price ratio.
And yeah, it's the monthly rent. Just want to make sure.
Rent, right? So going back to my example at the beginning of the webinar, I said $1 million home will rent for $4,000. That would be 0.4% or 0.4%. And the interesting thing is the second concept is that different states do have very different rent ratios. And then of course, the last one is that cash flow is king. He had done well. The property had appreciated immensely. He had a lot of wealth in it, but cash flow is king. And there were some things that showed up in that as we worked on the sale. So due to the unique aspects of the property, it was an zoned equestrian. There wasn't going to be any building around this area where it was in Bonita. We were able to sell it for a premium price. We got him $1.5 million, which netted him $1,427,000. We then assisted him with a $200,000 tax saving process. It's such a big number, I still have trouble saying it. And it's called a 1031 exchange, which is the IRS code. It avoided the 2 big taxes when you sell a rental property that has gone up a lot in value that you've had for a long time. It's capital gains tax, and then a bigger tax, which is called depreciation recapture tax. So he chose to purchase 4 new construction homes from a build to rent partner that we have in the Memphis metro area. There's no deferred maintenance since these are new properties and they're professionally managed. The combined rent is $88.30 per month and is guaranteed by the builder from the first day of ownership. It's a really unique offering they have right now. His net spendable cash flow, or mailbox money, is $52.83 per month. That's a 178% increase over what his San Diego property would have produced had he rented it $5,000. That's an increase of $33.83 per month, to dollarize that over what he would have achieved at $1,900 a month in spendable. Additionally, he now has 4 tenants instead of just one, so he has diversity there. And that means that a future vacancy will be 25% vacancy, not 100% like he had with the current house. And if we assume that he invests that cash flow, that $33.83 per month, with his Edward Jones advisor and just pegging it at, let's use a 9% rate of return, in 10 years, that'll yield an additional $650,000. So between the additional income and the increase in his investable assets, this move made the dream home more attainable.
Todd, before you go on to that one, I do want to add that a lot of the conversations we're having with our clients that own rental properties in California is the regulatory challenges continue to get greater and greater. And going to a different market, i.e. a different state, can alleviate or eliminate those private property issues that California treats very differently. I'll be non-political. They treat very differently than other states around the country, and Tennessee being a great example of that.
Yeah, good point. So case study number 2, this was a downtown San Diego condo. After buying his second home, our client kept his first home in downtown San Diego as a rental in the Aqua Vista Tower that you're seeing there. And his hope at the time was that as rents rose, he would eventually have a positive cash flow. And of course, as interest rates dropped over the last several years, we helped him reduce that negative cash flow through some refinances, but we never fully eliminated it, partly because the HOA fees had climbed significantly. The value of the condo was in the mid 600s, and he owed $276,000. The property was professionally managed; he wasn't doing that himself. The rent was $28.50 per month, with a negative cash flow that was a bit less than $500 per month. Okay. So the property had been purchased in 2005 and was now worth approximately $200,000 more than he had originally paid for it. The immediate goal was to rid himself of a negative cash flow. In rental property investing, a negative cash flow is often referred to as feeding an alligator, because if you get too close, the alligator can get you. That's like monthly negative cash flow, and then all of a sudden your water heater goes out, or you've got a roof leak and major repairs. So the long-term goal was to maximize his real estate investments over the next 10 years. So our discussion focused on 5 concepts. The first is the danger of feeding alligators, which another way to say that is that negative cash flows are rarely safe. And in fact, they compound, meaning if you're not setting aside money to replace the roof on a house you own, and if that roof today costs 20 grand, in 20 years, if the inflation rate on replacing that roof is just 3%, that's going to be like $35,000 in 20 years, right? So the cost to replace this goes up without having the money set aside to do it. The second is the rent to price ratio. I already covered the monthly rent in his case, which was $28.50 divided by the value, which was in the mid 600,000s. The different states can and do have different ratios. In his case, also leverage magnifies returns, because his goal wasn't so much cash flow today. He wanted this investment to really benefit him the most in 10 years and just wanted that negative cash flow to go away. So leverage maximizes returns. And then diversification through syndication, which I'll go into more specifically on the next slide. So his first move was to make a $50,000 pledge of equity to a real estate syndication. That's what you call a group real estate investment that Dan and I are run. Syndication is the SEC term for that. But we're buying single family rentals in Michigan in that fund. To date, the fund owns 14 homes with a value of a little over $1.4 million. And gross scheduled rents of almost $17,000. So when you talk about rent to price ratio, and that states have different ratios, I mentioned earlier, San Diego sits at like 0.4% or 0.4%. We're hitting 1.2% with the properties we're buying in Michigan. So he pledged his equity to get into that. When we sold the condo, we sold it for $660,000, and we assisted him with the 1031 exchange to avoid capital gains tax. His net proceeds in the exchange were $294,000, and that was after paying the $50,000 of the syndication. And he used that to buy 3 new construction homes from the same build-to-rent partner that we have in the Memphis metro area. The total property value of the new homes was $944,000, with guaranteed rents of $6,275, and of course professional management there as well. So that's 120% increase in the rent. Remember, he was getting $28.50, and he was going into $62.75. So massive increase in rent for this same total dollar value of real estate. But he also took down 43% more property value. So he went from $650 to $944. So the additional benefits to him are 3 tenants instead of 1, right? So if he has 1 tenant move out, he's only got a third vacancy, not 100%. He has more control of his property due to there was a minimal HOA on these homes, which is like you can't park your RV on the front lawn kind of idea. Whereas the HOA in the Aqua Vista building was $830 a month. The HOA fee he's going to have with these new homes is $30 a month, right? So there's a difference of $800 there. And the Aqua Vista building, you know, those big HOAs have a lot of rules as to what you can and can't do with your own property. So you have more control.
And I think the minimal HOA with the people in Memphis that we're working with is really kind of a genius move, where I think, Todd, in one of the developments, it's $10 a month or something. I mean, it's amazingly low, and they've introduced it, the HOA, just so they can have quality control over the neighborhood.
Right.
So it's really fascinating.
Got to mow your lawn, can't have a car up on blocks, that sort of stuff.
Yeah.
It's a really smart move to protect the investor's investment to begin with.
Yeah, and real quick on the 1031, if anyone's online that doesn't understand or needs more information on the 1031, just reach out to Todd or me. And we also work with somebody locally who is one of the industry experts in it. So it's really cool to have that connection locally for us.
Now, he also went to a small positive cash flow, albeit a small one, but you know, when you went from almost 500 negative to anything positive, like that's a win. He diversified into 2 major metro markets, and if he reallocates that $500 a month negative to an investment account, we'll use 9% again. In 10 years, he'll have another $100,000 available to him. So that's part of that cost of that condo. It's $100,000 in 10 years. So picture this. It's a few days into the month, and you know, coffee in hand, you wander out to your mailbox. Mine's a slot in the side of my garage. It all dumps into a little metal box. But you know, inside the mailbox is a bit of the usual junk mail, a few bills, and the most important item, a check from your property manager. As you stroll back into the house, you think about the fact that this isn't your first check. You're a few years into this, and it's been fun to receive a steady income through your mailbox. You think, sure, I've had a few repairs and things come up, but it wouldn't even be fair to call them mistakes, more like earlier than expected. You followed the steps we've talked about. You understand what to do. You targeted high cash flow markets. You followed the criteria for buying right in order to mitigate the dangers, ensuring that each time you bought it was always the right time. You compounded the cash flow by reinvesting it into additional high cash flow properties. But today's different, because at this point, you see your neighbor walking out to his car to head off to a job that he's told you many times. He's just absolutely over it. He hates it, but it pays well. So he keeps showing up. As you watch him drive off, you set your coffee down. You almost absentmindedly open the envelope. As you look at the amount of the check, the usual feeling of peace and security, this time it's different, because this check's not only big enough to make your mortgage payment, you realize there's enough to live off of. Unlike your neighbor, you now have a choice, a big choice. You can continue working if you want to, but you no longer have to. You have time on your hands. You have freedom. That's what life will be like for you once you get the ins and outs of our approach to finding high cash flow rental properties. So with that in mind, knowing what you now know, do you feel more comfortable with investing in real estate? Can you see yourself using what I showed you today to help you grow your investments? Are you happy you came to the webinar today? Would you say our time was well spent? If so, give me a thumbs up in the comment box. Let me know what everybody's thoughts are there. So I see a few thumbs up. Thank you. So, you know, I'm glad I worked hard on this, but here's what I know, which is one measly webinar isn't really going to go about creating change in your life that you want and deserve. You actually have to take action, right? With all things life. Knowing this, as I developed this webinar, I realized that there were two ways to help you. The first choice is I could share what I've shared thus far, end of the webinar, and then offer to help you individually. If that's what you decide, great. My team and I are happy to help, but it left me wondering about the complexity and the danger to you alone. And that's when I set to work on the second choice, which is that I could take a more active role and responsibility for your success, to create a situation where I would do everything I could to make your success certain by doing it all for you. The second option is what we've already alluded to, and that's that group investment pool that diversifies your risk. Instead of you buying one property alone and retaining all the responsibility and risk for that investment, we've set up what's called a real estate syndication. The first one that I've talked about already is closed. We can't raise money into that one, but we do have a second one that will be starting soon. And so really the difference is like planning a wilderness excursion. You know, on the left side of the slide there, you can work with a store like REI and they'll sell you the equipment, but you might not be properly equipped. Alternatively, you can hire a guide and they'll make sure you're well provisioned, well fed, and well taken care of because they'll be living with you. So imagine owning 5% of 20 homes rather than 100% of one. Now, at the beginning, I told you I was not going to do a commercial on our time together, that I was going to focus on, you know, just content. And I've done that. I've also stated that at the end, I'd mentioned this opportunity. So, you know, if you're interested in exploring how either option can work for you, you know, if it's exciting to you, you want to look into how to invest individually, out of state where the cash flows are higher, or as part of the group, you know, then all you need to do is send me or send Dan an email to schedule time on our calendars to explore your options. The truth is you're probably going to need more information if it's even right for you. So we've got a list of questions that we ask to really drill down to understand your goals and to make sure that we're not giving you opinions, that we're giving you advice, you know, sound advice. So Dan and I both have time available on our calendars over the next month to help you explore those options. It's of course no cost, no obligation. No one's going to apply pressure to you. As you know, neither of us have a boiler room sales team or anything like that. It's just us. So if you want to talk to me, you want to find out more about either option, you know, investing individually or as part of a group, we'll have a great conversation. No pressure. We'll figure out your game plan for you. And at the end of it, you're going to know if it's right for you or not. And if it is, what your next steps are. I'll make them very clear. So will Dan. So there's no risk. It's a risk-free opportunity. All you have to do is send us an email. Take the next step is book a session with us, right? So let's jump to questions. Do we have, any questions for anybody that's been on the webinar? Anything in the chat, Dan, or?
Yeah, I just answered, Chris had a question about the recapture tax and I think in general the 1031, and I'll handle that with him online. Heidi's iPad asked a question. I like that. Is it better to buy another property or to build an ADU? The answer is yes. But Todd, go ahead.
Yeah. That gets into some of the questions that we ask. Like if an investor has no experience with construction, then adding an ADU, there's an element of risk you're adding in that someone with construction experience doesn't have, right? And I like to say that gambling is adding a risk where there was none before. So adding an ADU could be a brilliant strategy. It could make all the difference financially. But if you don't do it right, it could expose you to massive both legal and financial liability. So we'd want to drill down onto both the investor's experience, a little bit about the property, where's it located. I do like adding ADUs for those investors that understand it as a value add to then sell the property, because the legal liability here in California, and I think Haiti, I think you're talking about your property up there in LA. The legal liability in California is getting more and more ridiculous. There really is no other way to describe it. For example, a landlord is no longer allowed to ask two questions. Do you have a pet that you're going to bring into my home that I'm renting to you? And do you have a criminal record? Your state law bars a landlord from asking that, which is just bananas, right? So we already have a problem with insurance, property and casualty, homeowners insurance, with prices going up significantly. And when you add on things like a landlord cannot ask if a tenant has a pet, how does an insurance company value that risk, right? They can't. So everybody's insurance is going to go up. So there's a lot of just both economic as well as legal liability reasons that I'm not super excited about California. But the specific answer to your question personally is going to vary based on your personal details and circumstances. Some clients, it's a brilliant strategy to add an ADU, but they don't have the financial capacity to do it. Therefore, maybe the best option is to sell.
And we're gaining more and more clients that are doing the ADU thing. And there are a percentage of our clients that love the idea of different increased cash flow in different markets, but they just can't get over the fact that I can't touch it, I can't see it. And we're not here to convince anyone to change their whole mindset on that. But we're having more and more clients do the ADU thing. And a couple of the big lessons are, it will take a long time to get done. You're going to have, I've got a client who did one in Bonita, beautiful. I think $250,000, 300,000 he spent on this thing, and he's going to get a ton of rent for it. It's going to be awesome for him. It took 2 years.
Yeah, the permitting process alone is brutal, right?
So not to push anyone away from the ADU on it, but just like a lot of things in California, there's regulatory challenges, and there's just people just aren't comfortable waiting that long. Now, for those people who really just want to do it, I'm connecting people. My guy who did it in Bonita recently says, man, have anyone call me. I'm happy to share my experience with them, and happy to do that. But like Todd pointed out, there are challenges, big challenges.
And it has the advantage of adding significantly to the market value or marketability of the property. So if, for example, I met with an investor yesterday. She and her husband have an older home up in LA that they already have 3 units on it. So 2 units each that are 1,900 square feet. I'm forgetting what the third unit is, but they're now building a studio that's going to be 350 square feet. And that should be done in the next month or two. And so she was asking me, what should I do? Well, I said, what do you think the market value is? She says, well, probably $2 million. Okay, great. If everything broke your way, she mentioned one of the tenants in one of the larger units is interested in moving into the studio. So she'd get him top rent on the studio, and then she'd be able to go get more rent on the unit he's currently in now, which is a little under market. I said, so if everything broke your way and you got the max rent that you think you could get, what would that be? She said $8,800. That's on a $2 million property, right? So that's 0.44%. If you go to a Memphis market with brand new construction single family homes, you're going to get 0.6, 0.65 in that range on that rent. So in other words, her $2 million, instead of being, let's take 0.6%, instead of being $8,800, would be $12,000, right? So all things being equal, would you prefer $8,800 in rent and, let's just call it the stupidity, the Marxism that is California state laws, or $12,000 a month in rent and state laws that respect property rights, right? That's the reason to deal with sort of the intellectual, like, I can't see the property, although this builder loves to have investors fly out and they'll give you tours and roll out the red carpet for you. But this idea that I can't drive over to the property because it's not in my city, right? We're not talking about selling something that you have locally and moving it out of state to nibble at the margins, that it's a little bit better. We're talking about significant differences, like what was Aaron's the second example, 2,850 in rent to what was it, 6,000 in rent? I forget.
Yeah, 5,800. Yeah.
5,800 in rent, right?
And that's the huge important lesson. And I've had conversations with a client of mine, one of them who's now in East Coast in Virginia Beach in the Navy, and he loves his downtown condo. It's got a VA loan on it of 2.25. He's got a renter in there. And he says, Dan, I don't want to sell it because I plan on moving back into it 10 years from now. And I said, well, then this is not for you. You know, so we want to make sure it's in alignment with your goals, your philosophies, and everything else. And Todd and I started working together 15 years ago. And one of the first things we really focused on is we want to enhance the lives of everybody we come in contact with. And we're not trying to sell you on anything. We're just trying to help you get from point A to point B as quickly and as efficiently as possible.
Absolutely. Any other questions?
Nope, I've been following up. Scott had a question about the new syndicate and a presentation on that. And I said, we got some work to do. But we'll definitely get.
Let me mention that. So the attorney I'm working with, a law firm out of Arizona that's better than the New York law firm we did with the last one. He just sent me a sample set of docs, first draft earlier this week. I haven't had a chance to read it. We're also going with the new portal, and it'll be launched in the Syndication Pro portal. So we've still got Dan and I need to build some of that out, the investor presentation, sort of slide deck with it. Given that it's my original goal was to try to launch it August 1st, given that it's July 25th, that's probably not happening. But I think it's realistic to say, but before the end of August, so that we could have like a September 1st launch date on that one.
And, you know, one of the things at the beginning of the webinar is learning lessons that's better borrowed than paid for. Well, Todd especially, but we've paid for lessons personally, and we're getting better at the syndicate thing. There's a lot of lessons there.
Yeah, absolutely. Absolutely. Any last questions before we let everybody go? All right. Well, I promised to be under an hour. We're at 56 minutes in. So thank you all for attending. Please reach out with questions. You know, Haiti, especially, I think you're thinking about some of your properties. Let's schedule some time to talk. And I appreciate y'all showing up today. Have a great rest of the week.
Thank you so much, everybody.
Thanks, guys.
Thank you.